All right, so this is my book report, I guess you call it, on Why the Rich Get Richer by Robert Kiyosaki and Tom Wheelwright. Happen to have a hard copy of this book right here. A lot of times I read off of Audible, so I'll hold up my phone when that's the case. Here's what the front of the book looks like, the one I have at least. Here's what the back looks like. And this is the soft cover edition. And with that, sharing my screen with just some bulleted reviews here. My name is Max Rock. Here's a brief introduction about me. This is the book club currently of the Geek Group members who are in the Geek Group Plus or above subscription, just out of the sake of limiting it to some group. I am a real estate investor and an educator with a background in engineering and business. I have both an engineering degree and an MBA and an education degree. So, and I've been investing in real estate for probably since 1996 in one form or another, whether it's been single family homes or multifamily properties or syndications. If you want to find out more about the Geek Group, then find us at MultifamilyGeeks.com, and you can explore from that website. So what does the book look like? I held that up and showed you the cover. And let's get to the authors. It's written by Robert Kiyosaki and Tom Wheelwright. The other books that Robert Kiyosaki has written are The Cash Flow Quadrant, Rich Dad, Poor Dad, and he is famous for making the Cash Flow Game, which is a board game that models investing in commercial real estate. And that board game, if you go out to buy it online, make sure you're getting the authentic game. There's a few of them that have been produced that look a lot like his board game, but they're different. So make sure you get the correct ones, the correct one. So, and then another book by Tom Wheelwright is Tax-Free Wealth. I do have a copy of that somewhere here. Here's Tom Wheelwright's book. He is a specialist in tax-free strategies. And I'm going to talk about his theory here in a second because he and Robert Kiyosaki go back a long way together. So let's see here, tax-free wealth. A quick overview of the table of contents. Here's some of the topics in the table of contents in Why the Rich Get Richer by Robert Kiyosaki. And table of contents is way in there. Sorry, I couldn't find it quicker. So why the rich are getting richer. What should I do with my money? Talks about people that say, if I have $5,000, what do I do? Why savers are losers. He talks about how saving money is not the way to go if you intend to become rich. Why taxes make the rich richer legally. I'm going to talk about that in a minute. Why mistakes make the rich richer. Talks about how crashes and problems with the money supply make the rich richer, how they use debt to get richer. He talks about financial education, playing games like Monopoly and his cash flow game. And then he talks about the quadrants, which I'm going to cover right here in a second. And yep, I'm going to do this too, you guys. Please don't mind that. Okay, and then he talks about the best story at the end of this. I'm going to talk about is how buying a Porsche made me richer by Robert Kiyosaki. So there's what the table of contents look like. All right, let's talk about his cash flow quadrant, because this is one of the books. He wrote two famous books and other books too, by the way. Kiyosaki's written quite a few books, just to let that be known. But the two that I like the best are Rich Dad, Poor Dad and the Cash Flow Quadrant. I actually read Rich Dad, Poor Dad first, and then I read the Cash Flow Quadrant, where he explained the quadrants more thoroughly. And so I recommend that one more than Rich Dad, Poor Dad. I like the Cash Flow Quadrant. So what are the four quadrants he maps out? E is for employee, S is for self-employed, B is for business owner, and I is for investors. And he maps them out on the top left E, bottom left S, top right B, bottom right I. So he talks about an employee. An employee is the highest pays the highest taxes of any participant in our society. The employees of the United States carry the financial burden of the entire country. They pay all the debt and the interest on debt, etc. They're the ones who bear the burden. Then he talks about the self-employed. And if you move up into a self-employed position, you pay slightly fewer taxes, slightly less taxes, but still a high tax burden on the self-employed. Only when you start to move to a business owner, now he defines business owner as 500 or more employees, but you can imagine the difference between self-employed being only you and moving into 2 or 10 or 50 employees being a major step in owning a business. By the time you hit 500, this business doesn't rely on you at all. It's a machine running that generates its own wealth. So business owners, of course, pay fewer and less taxes. And then the final step is the investor. An investor has moved to a point where they don't work for money anymore. They are creators, or they get paid for creation. And I put in there like God, right? What's a name for God as a creator, right? No matter what your vision of God is, creation is a component of that. And that's the point where the quadrants are pushing up through those different moves to investor. That's the highest level. So then Kiyosaki talks in this book a lot about financial education. He talks about getting a degree through the university system. So you go out, you do what your teachers in high school tell you, go get your college degree for 4 years, then maybe go get a higher level degree and start working as an employee. He's talking about what a bad idea this possibly is, because the degrees are expensive, and oftentimes students emerge with debt from their college degrees, and oftentimes that debt sticks with them for years, sometimes decades. Those expenses for the university system are not tax deductible. So you're back to the idea of the employee paying the highest amount of tax and having the greatest degree of financial burden for moving up through this system. Then he talks about contrast that with financial seminars and trainings that you go to for specific purposes. He says this is the type of education that the rich pursue because they can pay for these out of before tax money. These are all tax deductible types of trainings. Then he talks about the financial education, distinguishing between when you are going to seminars and trainings that are tax deductible. Make sure you're going to the right ones within that, which is educating the individual on moving up through those ranks, through the quadrants toward the investor status. Some of the interesting aspects he points out, decades ago, Kiyosaki said your home is a liability. And this, of course, has been controversial to many financial experts. They say that most Americans hold the majority of their wealth in their personal home, which is true. Kiyosaki's definition of a liability is something that you pay. It costs you money. His definition of an asset is something that brings money into your balance sheet, that earns money. So by the nature of his definition, a home that you live in and then pay the mortgage on is a liability because it takes money out of the family coffers and puts it in somewhere else rather than putting money into the family coffers, right? So that's his definition of a liability versus an asset. Okay, so then he talks about long-time money myths and why are they myths. He talks about how right now savers are losers. And he admits that this has not always been true. Going back 100 years, there's different situations in the financial setup of the American economic system. But for now, where we are right now, he says saving is the worst thing you can do with your money. And his obvious go-tos are inflation, which makes money that you save worth less, and the idea that as a nation, we continue to experience, he calls them money disasters. So the value of money continues to reset with each and every new disaster. And we've just lived through one being COVID, right? Resulting in the government pumping trillions of dollars, 2 or 3, or I think 5 over time. How many trillions the government has pumped into the system, resulting in that inevitable inflationary pressures that make the money you save worth less. And then he talks about how crashes make the rich even richer, and understanding the cycles of those crashes. And this is something that sits well with us as multifamily investors. We know that through time, multifamily has cycled through being very expensive and then being not so expensive. And any one of those cycles can take a person from zero to hero, I guess. You can go from almost zero money net worth to a decamillionaire status in one of those cycles. Okay, then let's talk about Tom Wheelwright. So this says Wheelwright on taxes. Let's put in Tom there. Tom Wheelwright is a tax expert and has fostered a network of accountants that preach what he preaches. And what does he preach? So he talks about the concept that some believe that we need to pay taxes to be a true American. So pay your fair share, right? Pay your part. That's one perspective. And I've definitely heard that. And at times, maybe I've even believed that before. So he's got a different perspective, and I'm going to try to explain that to you and do his philosophy justice here. He says that, do you think the government has a good record of spending money well? So why are you going to send your money to the government, right? You've got to second guess that idea that we're sending taxes into the government and somehow they're spending it well. May not be true. And again, he'll leave that up to the reader to decide. So Tom says that the government tells us what to do and incentivizes us with tax breaks. So the government has written, and it's Congress, they've written a tax code, and a very few pages of the tax code tells you about what you need to pay. The rest of the tax code of the 3,000 pages tells you how to get out of paying if you do what Congress wants you to do. So his argument is Congress is telling you exactly what you do to be a model American. And the closer you get to that, the fewer taxes you'll pay. They have incentivized, it's one of the great incentives of government, is being able to cut your taxes by doing what they say. So follow what they say and you'll pay less taxes. So his point is that the true model Americans are those who pay little or no taxes to the federal government. All right. I like Tom Wheelwright's perspective. And just so you know, I have actually personally, I've hired one of his network accountants this year. I left my 25-year good friend accountant and moved to one of his network accountants to see if I can reduce my overall federal taxes and do more of what the government says. And just as to go back through the quadrant in this regard, that's why employees pay the most in taxes. They're the least valuable to society. Who becomes more valuable in the eyes of Congress and the tax code? It's the self-employed, and then the business owner, and then the investor. Why? The business owner, because when you start creating 500 or more jobs or any number of jobs, you become more valuable to society, right? So this economic engine of America thrives on the creation of additional jobs. And then the other thing, when you become an investor and now you're a creator, you're not working for money. You don't get paid money. You get paid based upon your ability to create organizations that create jobs, right? So the investor now becomes the true engine of the American economic system. And that's why the Congressional Tax Act, that tax code, incentivizes all of us to move into investor status, if at all possible. All right, so that's Tom Wheelwright's opinion on taxes. By the way, Tom Wheelwright has been Kiyosaki's accountant for decades now. So a lot of Kiyosaki's wealth has come because he joined forces with Tom as his accountant and has been living this philosophy for for a long time in his career of investing, right? So Kiyosaki and Wheelwright both say that you're going to build wealth through two things: debt and taxes. So debt might be more obvious to us as investors. We've been using debt for a long time. We understand the concept of other people's money. We can grow investments more quickly. We understand the concept of leveraging a bank loan, and then say it's a piece of real estate. If it's $1 million piece of real estate and we only have to put down 200,000, if the investment value goes up 10%, that's $100,000. We only put down $200,000. $100,000 gain on $200,000 investment is a 50% return, right? So we understand by using debt, we can leverage our cash and get a higher rate of return. So that's debt. And then when it comes to taxes, if we can pay 0% taxes to the federal government, then we can totally go out and use that money to make additional investments. So why the rich get richer? They understand these two tools. They understand that in minimizing their taxes through a lot of the strategies we know. In multifamily, we have depreciation, accelerated depreciation, and this thing called cost segregation, where we can write off large parts of our investments early in the investment. And that all helps to offset what we pay in taxes on gains. All right. So those two things, taxes and debt. If you can pay less in taxes, that gives you more money to invest. And then Kiyosaki mentioned 3 types of income, and these get better as you go up. Earned income would be what an employee gets. That's probably the least valuable of all money, but nonetheless a part of every strategy. And then portfolio is more of the thought of, investing in the stock market, which gives us some control, but not very much. Again, not as good. And then passive investing is where you're a true investor. You're really going based on creation and the idea that what you're doing is putting together a package or a program that allows for multiple organizations with many jobs within it to be created, the creation of value, right? It's not about a pie. It's about creating an infinite number of pies. Okay. And then he mentions one thing here: hidden incomes of investors, equity growth from rentals where tenants pay the mortgage, value growth from inflation. So just the natural outgrowth of investing that makes it more likely that investors are going to continue to grow wealth. Okay, so let's talk about the last thing. This is probably the best part of the book to me, and I think the story that we should all remember. He talks about how buying a Porsche made me richer by Robert Kiyosaki. He says he and his wife have a vow: we will not take on a liability without first finding an asset to pay for it. We will not take on a liability without first finding an asset to pay for it. Okay, so $150,000 Porsche comes on the market and it's for sale for 50 grand. It was during one of the recessions. There were issues of why the $150,000 Porsche was being let go for 50 grand. He's on a list with his dealer, knew he was looking for this particular car. Apparently it was the number one production model of one of the models. I forget the details. That's not the point of the story. But here's a Porsche he wanted really badly, and here it is on sale for 50 grand. So he very much wants to buy this car. Now, he and his wife have 50 grand in the bank, cash, but they have this vow that before they can take on a liability, they have to take on an asset to pay for it. So what does he do? He goes out and finds a storage unit, and the storage unit costs $250,000. He uses the $50,000 in the bank as a down payment on the $250,000 storage facility. So he took a $200,000 loan. The facility generated $3,700 a month in revenue, and $2,700 a month was what the loan cost to buy the storage facility. So it allowed an additional $1,000 in there was above and beyond the expenses of the investment. That was the cash flow beyond that. So the extra $1,000 he went out and took a new loan for $50,000, and he bought the Porsche, and now the $1,000 from the storage unit paid the loan on the Porsche. And he goes back and explains how buying the car, a $50,000 car, if you had just outright taken the $50,000 and bought the car, he's now trading his asset, his $50,000 in cash, for a car, which in general is not an asset, right? It's a liability in terms of it costs money to keep up. It costs money to buy, right? So by putting the $50,000 into the asset, the storage unit, that $50,000 not only still stays there, but if the $250,000 storage unit goes up in value, say it goes up 10%, that would go up another $25,000. He's actually making money. So he has upside gain in terms of the equity growth, and it's a hedge against inflation. If inflation continues, then the value of that property is going to continue to go up because the dollar can buy less. So this is his story, how buying a Porsche made him richer, as long as he followed the vow, which was, we will not take on a liability without first finding an asset to pay for it. Okay, so here's a summary. The summary is get real financial education. So don't go for the college degree, but look for seminars, and look for seminars and instruction and mentoring and all those kind of things that you can pay for and deduct. And look for ones that fit the real truth about financial growth. And then find assets to offset liabilities. Always focus on the assets first. And then for me, this book, my overall rating of Why the Rich Get Richer by Robert Kiyosaki is definitely a must read. This is a favorite book of mine for sure, and it's going to go to the top of my list. And I like Tom Wheelwright so much, I actually hired his group to now one of his network accountants to be my personal accountant. So that's new this year. I'll have to get back to you on how that pays for itself.